Good afternoon, everybody. Welcome to TraderMerlin Show for your Thursday afternoon edition. It is the 4th of August today. I'm sure that many of you are eager for our guest to join us today. As we've talked about over the past few months, we've seen some just ridiculously crazy moves in some of these commodity markets. Corn, wheat, soybean, lumber, some of them down 30, 40, 50%. And my gut keeps telling me that I just feel like this is going to start to impact our inflation numbers coming down maybe next few months down the road. But I guess the bigger question is, why are they falling 30, 40, 50%? And why were they up so much, right? It's become one of these most intense asset classes out there. If you're a futures trader, there's tremendous opportunity as well as a lot of risk. Now, I am not a heavy commodities trader at all. If I do, it's going to be gold, silver, a little bit like that, but not really into the soybeans, wheat, lumber, cotton, sugar, cocoa type of things. But I do have a friend of mine, a guest, or a gentleman who I've worked with for many years through Online Trading Academy. We've got Don Dawson joining us today, and we're going to talk about trading commodities. Don is not only going to join us, but he's going to join us with his camera on today, and there it is. Don, how you doing, my friend?
Hey, how you doing, Merlin? Good to be here.
Fantastic. Great to have you with us. It's been quite some time. I felt like I was trying to chase you around for a while, but I've got you now, and you're not going to get rid of me at this point. So I'm
You have a fan club that is brutal. I'm telling you, I get phone calls, emails, in person, going like, "What did you do to Merlin? What did you do to Merlin?" I'm like, "What?" He was like, "He said you ghosted him." I'm like, "Oh no!" So you do have a fan club. Let me tell you, they're looking out for you.
Well, you have one as well. It's great. I'm going to real quickly just show a whole bunch of charts here to kind of set the stage for this discussion. For the viewers out there, I'm going to just look at things from the big picture. So here, I'm looking at weeklies. I'm just going to click through a whole bunch of commodities just to paint the picture. Now, really, since COVID started, a lot of them have just gone gangbusters to the upside, but we're experiencing a significant pullback. Here on the screen, you see corn. Here is the cotton chart, which has just been decimated. You've got lumber, which is going to be a great talk track for today. Things like natural gas, which is still near the highs, but has crazy trading volatility. Here's your corn chart. I've got soybeans. It seems to be almost everything out there, and copper, because I know we got Skilled Stocksman here, and he wants to talk about some copper today. So, Don, maybe you can help me understand a little bit about, what's going on with commodities. Why are we experiencing 30, 40, 50% declines in such staples?
Okay. Well, it's interesting because if you have long-term charts, which is what kind of live by, is there's monthly charts. When you go back and you look at these things, you see that we have all-time highs in a lot of our markets. When we had the scares that came into the market, whether you want to talk about basically when they went to the green, what do they call that thing, the green bill, whatever it was back when Biden got in office, and then also when Ukraine was attacked by Russia, all of that was just kind of like throwing gasoline on a fire for all of our commodities, right? So, with being that Ukraine is a huge exporter of grains, it's like corn is like the number 3rd exporter for corn, I think it was in that country. So huge exporter of that. And so when there was threats about like, oh my gosh, we'll never get corn or grains out of that country again, that just added fuel to the fire as well. And don't forget, corn is a huge ethanol producer, used for ethanol as well too. So it can add fire to even higher oil prices too, to keep that going higher. So that's part of it, that we had this huge rally going up. And there's usually some big catalyst like that. Back in 2012, I'm just kind of looking over at my chart now, that was the worst drought we had in 50 years. 2008, that was back when we were having a lot of third world countries were just getting bigger and bigger, and there was a huge demand for commodities. And that was the time oil went up to $147 a barrel, for example, and that took a lot of our commodities up with it as well. So there's usually some kind of a catalyst that causes that spurt to go up like that. And then when it gets up near these all-time highs here, it's when people talk about, like when we were going to corn this time, looking at my chart, it was around $8 a bushel, and people were saying, oh, it's going to be $10 a bushel. There was even farmer producers of corn. They were out there making news and headlines or making comments saying, oh, you know what, we think as long as we can stay above $7, we're going to wait and see if it goes higher to put some hedges on. Corn hasn't been above 840 in history, right? I mean, that's the all-time high. And here is a professional commercial trader or somebody who uses this stuff day in and day out saying, no, it's going higher, making the same mistakes retail traders make. Whereas if they just look at the charts, the odds of that thing breaking all-time highs and going much higher is slim to none. It's unbelievable how many times, if you go and look at monthly charts and go way back in time, 1970s, 1980s, you can see these patterns in the market. And they just have a very hard time breaking through there. It's almost like they say it's like where supply and demand goes into equilibrium up at those levels where the consumers or the processors of these commodities they're trying to buy it because they're forced to buy it for their customers, and you got the producers selling it to lock in the high prices. But at some point, it just comes into an equilibrium and it just stalls there. And once it starts to stall, and the consumer processors are not buying anymore, and the producers just start jumping on board and selling this stuff. And that's exactly what's happening, because remember, these contracts can go out 5 or 6 years into the future, crude oil 9 years. So these commercials can lock these prices in for, say, 4 to 9 years out into the future. Even if it goes all the way back down to $2.40 a bushel for corn, farmers, producers, they can lock this 750, 760 area in up here for years into the future, which normally, corn hangs around production costs right at $3.50. You would think anytime a farmer's going anything over $6, they're going like, what is this, Christmas?
Yeah.
They're going to lock it in. But they're just being crazy, thinking, oh no, it's going to go higher. And if you listen to the news and the media, that's what they'll make you think. Because remember, the news gets paid for advertisers. And the only way to go get advertisers is to make silly stories up about how this stuff is going to the moon every time. And I always say it's different this time. Don't you hate that line? It's different this time. No, it's not. It's the same crap. It's up to the all-time highs. This is it, So now, would I step in front of it and sell it? Heck no. When the daily trend rolled over, that's when I started getting interested in shorting the market up here. I certainly don't get tops for big tops, and I don't get bottoms. So my trading is a trend following, and I'm in the middle there somewhere.
Nice. So everybody's asking. I'm working on the audio, but I've got him turned up a lot. For some reason, it's echoey, but unfortunately, we got to deal with that as it is. It's okay. It's all good. We'll unfortunately a little echoey, but nothing I can do with it now. Beauty of a live show. So you were mentioning corn, and I got that corn chart up here, and obviously looking at the lows we saw from 2020, we were down around $3 a bushel, and we spiked all the way up to $8.40. What sort of things are you looking at to help you gauge and say, okay, here's where I think it's going? Because what I look at in this chart is I'm just looking at incredible volatility. And I don't look at the commitment of traders. I'm not looking at these ag reports like you do. So what sort of, guiding principles would you have for someone looking at commodities to say, okay, this is what you need to help forecast where these things are going to go?
Okay. Well, the first, you mentioned one, that was the COT report, or the Commitment of Traders report, and you're looking on there. I mean, when you get up to these all-time highs like this, you start looking for the commercials just to get super, super bearish in the market here, meaning they want to sell as many contracts as they can to lock these prices in. The next thing comes in is seasonality. And as most people know, we usually peak out in corn prices around May or June, and then the price tends to go down into the harvest season. And that's only because of the markets know there's a huge supply of corn coming to the market in the fall, and so that's what the market gears up for year after year. And it's kind of ironic because when you go back and look at those last 3 peaks, like 2008, 2012, and now this peak, same thing, peaks out, and now the market wants to creep on back down into the harvest season. So unless something happens with Ukraine literally being totally shut down, there's just so much corn in the world, I shouldn't say in the world, but there's so much corn that's going to be available. Brazil's coming out with their second crop because they're in South America, they get 2 crops per year. And so their second crop is coming out. It's supposed to be a bumper crop this year or this time around. So it's going to be coming out very soon, and that's going to put some competition for exporting corn from the U.S. So even if we don't have the corn, Brazil is going to have a bunch of corn to get out as well. So anyway, the seasonal pattern, that COT report, and obviously trend, and then where are we coming from? When you're coming from all-time highs like this, I mean, I'm a trend follower, but I use some common sense and say, we get near all-time highs, I do not keep buying. I'm just like, by the time it gets up to those areas, if I haven't bought it, I've missed the party, so forget it, I'm just going to stay where we are. Stay with wherever markets I might be in. But that's pretty much it, that seasonality and COT, and obviously following the trend, like I said, on the charts, but it's not much else I get into it. And keep an eye on some of those USDA crop reports, see if anything drastic changes in those. But they can be kind of erratic throughout the year as well. And that's one of the things we were going to mention today is they got one coming up next week. It's going to be a pretty important one for USDA's report.
I think that's one of the challenges we have with an asset class like commodities is, you look at something like a Microsoft or a Cisco, Intel, these types of companies, you think you can pretty much have a decent living just trading supply and demand and looking where it bounces. And I've actually had trader friends of mine in the past that got into commodities and tried to use, using what they deemed was supply and demand zones, and they're like, it doesn't seem to work right. And I think that there's a different driver here. I think the cornerstone of like on a supply and demand core strategy is institutions are buying here because of X, Y, and Z. Let's utilize that. But you have so many other factors that you need to focus on as far as the drivers of corn, wheat, soybean, lumber, all of those. And it blows my mind that you can stay on top of all that information, because even one commodity like corn would drive me crazy trying to keep track of all this stuff.
Well, it's interesting too. What people don't realize, and OTA is kind of guilty of it. They cram institutions down everybody's throat, right? Because they're used to trading stocks and everything else. And maybe in the stock market, institutions do play a big role. But seriously, in the commodities market, institutions are second fiddle to producers and processors, which are your commercial entity. If you go look at the Commitment of Traders report, you'll see a breakdown of the open interest. Remember, open interest is the number of positions that are entered into, not yet liquidated. And you will see that over 60% of all open positions are held by the commercials. So you see, if they're holding 60%, there's no way the institutions are holding anything bigger than the commercials. So we got to trade like the commercials, not like an institution. Okay, the institutions can come in and do something called swap deals, and they can become commercials where they make off-exchange contracts. So that because if you think about a futures contract, they're standardized, right? So it has to be delivered from the same place, expires on the same date, same value, same quantity of the commodity when you go off the exchange. But if you do something called a swap deal, things like Goldman and Merrill, they will make these what are their off-exchange contracts, and what they'll do, they're like a hedge for another company. And when they put those hedges on, then Merrill or Goldman, whoever it might be, can go into the futures market and hedge that swap deal that they have on, but they're not using it as a speculating tool like most people think they are. So it's not supply and demand zones so much that they're looking at in there. It's something completely different, on the fundamental side of hedging these swap deals.
Let's look at one of the big pieces here that drives commodities. Obviously, we've seen a dollar that has just been incredible. It's been like a kind of a to the moon type of asset class. It's been going up and up and up and up. Talk a little bit about how that might impact your decision-making process for your trades as you look at making commodity trades.
Okay, and I was going to touch on one thing here before we get off that corn chart. I don't know if you still have that monthly corn chart up there or not.
Yep.
I talk a lot about production costs when I'm in classes and stuff like that, and I try and show people, but you know how it is in class. I mean, your brain is just fried by about Wednesday.
Right.
By Thursday or so, you're talking about this production cost, and you can just see the glazed look in the eyes, and like, they did not get what I just said. You're sitting there going like, did you understand that? They're going, I sure did. Like, I get it. So anyway, but if you look at this chart, and here, this is what I use for finding production costs, and then I try to go out on the internet and just verify it with some fundamentals by just doing Google searches on this. But let's just take a look at the corn chart, like a continuous chart with a monthly chart on continuous.
Okay.
And what you'll see is, I take the last 10 years, okay, so right now we're in 2022, so if I go back to 2012, okay, I look for a pattern of lows around from that 2012 to 2022. Can you see the lows coming in there around 320 to 350?
Yep.
That is going to be the production cost of corn. Okay. And
yep.
You can see this goes over and over and over. And we can go look at other markets and see the same thing, not just corn, but gold, for example. I know the gold bugs hate me because they never liked I used to be on your other radio show or your other show. I talked about how gold was going down and down. And they're like, no, it's going to keep going higher. But if you come back and take a look at gold now, I used to think it was going down to 840, I think it was 850, but now that production cost is raised up. It's around $1,100 to $1,200 now per ounce production cost. But if you look at a monthly chart of gold, you can see in the last 10 years, that's where those major lows are down there. And all that was just the miners or producers of that gold locking those prices in down there. And now when price gets back down there, that's going to be the area for investment, area to be looking for interest down there. One of the comments I wanted to make is, whenever markets go to all-time highs, like we've done with most of our commodities except for gold, we've gone to all-time highs, and I call that a boom to bust. And in the commodities market, what boom to bust means is we go all-time highs, and from all-time highs, we go down to production costs. In almost every chart you look at on monthly charts, you will see that once we hit an all-time high, we'll come back down somewhere around those 10-year lows, and we bounce off those, and that's that production cost. What ends up happening when markets go to all-time highs is everybody and their brother wants to they want to sell, produce, manufacture that commodity because they think there's a large profit margin. So believe it or not, all-time highs lead to bear markets. because so much supply comes in, new supply comes into the market. It's almost like the market wants to turn around, take it all the way back down to production costs just to shake out all these new commercials who are coming in thinking they're going to be the next rich person because they're producing this commodity. And that just seems to be the back and forth pattern that I've seen year over year. And that's where I think commodities are heading now. We're probably getting ready for a secular bear market in commodities coming up that we're going to see moves back down into the production cost over the next few years.
You know, it's interesting. You know, obviously, you know, John O'Donnell, he used to always tell me the cure for a high price is a high price. And when you have, you know, commodities at an all-time high, there certainly is a keep up with the Joneses or chasing it effect, if you will, where people want to just jump on it. But at a certain point, you got to realize that a high price is going to all of a sudden come crashing back down simply because when you have lumber, you know, at such a lofty price, anybody who's making lumber is like, you know what, I'm going to sell all I can at this level. Whereas, and I'll just make it up. Let's say you got gold here. I'll bring up the chart of gold. You know, when gold is up at 2,000, you know, they're gonna sell it like hotcakes because historically that is more than they've ever made off of it. But if it gets down to 1,100, a lot of the producers may not actually sell their gold. They're like, you know, it's worth it for us to hold on to this rather than to sell it. So, you know, commodities, that's a very interesting dynamic. No one really says that with Microsoft or Cisco shares, like, oh, well, it's too expensive. I'm going to hold on. And it seems to be much more prevalent in the commodities space. So thanks for pointing that one out.
Very much so. That's why it's important to understand that production cost, because that becomes like a floor in commodities. Because you can imagine markets are not going to spend any or not much time under production costs. They can hang around there for a month or two, but they don't stay under there very long because it's not feasible for. And think of the investment these big production companies have. We're not talking $10,000, $15,000 like some kind of a franchise startup. This is billions and billions of dollars they've got invested in this production. They are not going to let this stuff hang around underneath there. And all they got to do is control how much of it they release into the economy. They might be tons and tons of that commodity laying around, but if they keep hoarding it and they don't release it, it's not available. So the slight bit of demand that comes along, once it gets in that production cost area, that's going to lead to higher prices, and then they'll start selling into that rally with the cash product. Let the holiday come out.
Gotta love it.
It's like a cycle. It just goes up like that, all-time highs, comes back down to production costs, and then now it takes a long time in between these markets times to do this. But it's the pattern. You still look at monthly charts, and you'll see the pattern yourself. It's over and over and over. That's why I don't get excited when we get to all-time highs. Everyone else is in the media saying, "Oh, this time's different. This time it's going to double. It's going to triple in price." Blah blah blah. I said, "Oh God, no! Here we go again."
What do you say to people? Because it's kind of difficult. You know, when you're saying it reaches all-time highs, I mean, obviously there is the belief, or not belief, but you've seen historically that something gets these lofty all-time highs, it's going to come down. You know, but how do you approach that? Because when I'm looking at supply and demand, I can very clearly look and see, okay, here's where I think I'm going to be selling because of X, Y, and Z factor. But if I look at, let's say, I don't know, gold coming into an all-time high, you know, as a trader, I can't say, well, I'm going to short it because it's at an all-time high, because as you know, it could make a new all-time high. So, you know, to me, that's a tough thing to be dealing with when you have just this kind of arbitrary, oh, it's all-time highs. I mean, how are you planning out, okay, I'm going to short this because it's at an all-time high?
Well, here's how I've had to face it, because it sounds easy to do, because you know this general area that the market is going to peak out. It's somewhere in here. It might go a little bit higher, it might be a little bit short of it. Like crude oil came up short of $147 with this last rally up, I think with 120-ish or something like that. But anyway, when it gets up there, here's the one catch to it. There's so much volatility when the market starts to top out. It starts to get the ATR, the average true range, starts to get huge, and the market swings are just huge. You really can't start trading it right there, but eventually the volatility starts to compress a little bit as you start to see the chart rolling over. And then for me, it's daily trends. Once that daily trend starts to start signaling some downtrend, that's when I can start trading it. Because I do not try and pick tops and bottoms, because like you said, this thing can keep going higher and higher. But once that daily trend turns, that's my conviction right there. And then I just use other strategies for, once I get the daily trend, I just got to, okay, where do I get in, set my stops, and, you know, start trailing a stop as quick as I can.
Nice. You've got a lot of students in here. A lot of people are giving you a shout out, saying hello. I can't run through all the names, but I've got Chris in here saying hello. He says they're one of your old students. What? I got T. Gauchert from Minneapolis. He says he was his first futures instructor. So quite a few out there. So
well, hello everybody. I can't see everybody's name in here. I see Merlin in my name, so I don't see anybody else's. But
and don't forget Sue in Boston. Don't forget Sue in Boston.
It's Sue in Boston, exactly. I had not. Yeah, Merlin would tell me about your name. I was like, I have not heard that name indeed. So it's great. It's great to hear everybody in there and with questions and everything like that. So. Hope to see you guys soon.
Yeah, everybody's asking where is he still teaching? Yes, he teaches for Online Trading Academy, but he just teaches for Kansas City.
Yeah, just going out to Kansas City and instructing out there now. So, yeah, but anyway, back when those charts there, I just want to bring that up about how these things go to all-time highs and then come back down to bust, which is production cost. I mean, bust in the stock market is zero, right? But,
right.
in the commodities market, it's usually that production cost in there. And remember, it has to be a deliverable product. I mean, like S&Ps obviously do not have a production cost. That's not something that's mined, manufactured, or anything like that. So.
I'm going to bring up one chart here, and I'm not sure your expertise on this, but knowing you, it's probably pretty damn good. One of the ones that's been staggering to me, and I'll bring the chart up for the viewers at home, is cotton. Cotton, just going back a couple of months, you go back to May, you're up at over 150, and then all of a sudden, in 1 month, it went from 150 all the way to sub 100. I mean, that's like a 30% decline in 1 month and keeps dropping. And from what I was hearing, I heard a couple things. We'll talk about the dollar impact, which, of course, I believe is part of that. One of the stories I read, and I want to get your idea on it, is China, who's a major textile manufacturer, was looking, obviously our prices have gotten so high that they just said, we're not going to be buying U.S. cotton, we're going to go buy Brazilian cotton. And therefore, our market just kind of fell apart. Is there truth to that, or am I just regurgitating horrible information?
No, there was some truth to that. And then obviously there were other things that were coming in there as well. But the biggest thing, I mean, the prices on here, when you went back and looked at that all-time highs, this market was just, one of the problems with markets like cotton and lumber as well, they don't have a lot of volume in them. Mm-hmm. And so what happens is they get overextended in that one direction. So it's very easy to make it look like it was really dramatic, where in reality, if there had been that many more traders in there to take the other side of this, like shorting it, for example, or a bigger commercial population, it would not have gotten as high as it did. But when they're really illiquid, like cotton or orange juice or lumber, they can do that kind of a thing. So that's why you don't step in front of those, that's for sure, because you will get run over in that kind of a market. It's kind of interesting because you talk about when we were trading up there in that 128, 130 area, and such high prices, everybody was going like, there was going to be a cure for this. We're going to bring back, what was that term? No, polyester. Polyester was going to come back. And I think that's what put the fear of God in the cotton market, was nobody wanted to see anybody polyester. But anyway, there were some rumors going around that we were going to start going to disco clubs and having polyester pants again. So I'm sure you still got a pair of your favorite ones laying around, Merlin.
I wear it regularly, man. Polyester's my best friend. It doesn't wrinkle. It doesn't stain. You can spill red wine on it and just go, no, it's done. Polyester is the best. Nice. So let's go back to the dollar. I'm just getting your take on it because I brought up the dollar, and we could talk about its impact on broad markets. But here's the chart of the Dixie, the dollar index, for anybody who's watching. Certainly, we have had a nice pullback right into an area of demand that we kind of were watching at 105. We've bounced for a couple days. I'm like you. Trends are your friend, and the trend is your friend to the bend at the end. If that's the case, the dollar is still in a beautiful uptrend, which in theory should continue to put downward pressure on commodities. Correct?
Exactly, 100% agree. And what's interesting is my daily trend is still, it's up bigger picture, but I'm in a sideways for the last, say, 2 weeks. And the same with all the other currencies, Euro, Pound, Canadian, Aussie. They're just sideways. They're just chopping around. So I don't have any positions at all in those markets right now. But when I see this kind of a correction, especially after an extended move up like that, this just tells me it's like there's going to be an opportunity down here. Just be patient, to get long the dollar again. So at some point we're going to break something that says, okay, that trend is not up anymore. I mean, I've got it sideways, but it's not down. That's for sure. So to me, it's just waiting for an opportunity for this to turn up. And I'm more interested in shorting the other currencies. I don't play the dollar index because, again, it's a super illiquid contract. And if I ever have a dollar bias, I just trade a euro against it, right? Because it's a 180-degree inverse pattern. So if you're bullish on the dollar, you sell euro. If you're bearish on the dollar, you buy euro. And you can do everything you want in that euro contract
right.
that you can do in the dollar and better because of liquidity.
Nice, like it. What do you see anything on the horizon that could break this trend, or do you care from the macro perspective, like what might impact the dollar? Or are you just kind of dollar's going to do what it's going to do, and I'm going to trade accordingly?
Yeah, I kind of stay with that. I know a lot of people study macros and all that kind of stuff. I glance at them, but I don't want them to dictate my trading ideas. I'm a trend follower. I just want to follow trend. And look at this trend. I mean, you look at the dollar index, and how many times did you say, oh, the dollar's peaked, oh, the dollar's peaked? Every time it keeps making a new high, right?
Yep.
So you can't let that type of stuff get into your head because it will make you miss a lot of trades, or it might make you something even dumber, and that is trying to short it while it's still in an uptrend. So yeah, I'm a firm believer. Let the markets tell me. The markets are the king. When any market you're trading is the king, and it is like the significant other. It's always right.
Yep.
Okay. It's never, ever, ever wrong. Okay. And if you try to prove it wrong, you will pay dearly. So if you just listen to the market instead of fighting it, trading gets a lot easier. And that's what I found in trend following. Once I got an idea of what that trend is, that made me a much better. I was a better trader then after I figured out trend than I was when I first started out with no clue of trend.
Yeah, absolutely. I'm in the same boat. I think a lot of people don't. It's weird. They don't look at trends. And there's a scumbag POS trader out of Chicago that thinks he's really good. Everybody knows I hate this guy's guts. And I had him watch on Power Trading Radio one time, and he was like, "Trend's not important." And I was like, okay, you're a freaking clown. You should just stop trading and quit telling people you're a good trader, because if you don't look at trends, you're an idiot. I'm sorry. You have to know where it's going. And if you don't know where it's going, you'll never know where it's been or where it's come from and how it's going to get to the new spot. So trend is critical, and I agree with you. I think it really it changed my perspective of trading as well, because I would trade tick per tick, and then I was like on 5-minute charts and 15s, but you can get sub-trends in there, but keep your eye on that bigger picture trend. And this dollar one, at this point, looks absolutely beautiful. And again, if dollar starts breaking down below 105, maybe gets below 104 and change, then I think you might see the reversal. But it hasn't reversed yet.
Right. And I mean, you got those two peaks sitting back up in there. What are they paying there around 104ish and up there around 104, 105? If we get much under those, that's probably going to be a good sign that that trend is, at least going to turn down in the intermediate time frame anyway, or intermediate term. But right now, there's nothing that says anything different here. The only thing I'm still bullish on interest rate products, like for price, not the yields, because we're in a seasonal, and you guys have been in my classes know I love this interest rate play. That July, August is a great time. And again, guys, these are not trade recommendations, they're purely for education purposes. But I'm just saying that there's a strong seasonal pattern between July and August, the end of August, that interest rate prices typically go up. And that is because the end of September is the government's fiscal year in, so they're not issuing as many bonds or as much debt out there as they normally would. So there's fewer of them in the market during these last 2 months of their year. So therefore, you get a strong rally. If you look at this year, it was almost perfect timing from the beginning of July up until where we are now. Mm-hmm. So it looks like we're starting to get ready to resume that trend, because it looks like we started going sideways here just a little bit a few days ago, and now it looks like we're trying to get another bit to make this August run to the highs. So that's that seasonality in the markets too. And all I need is seasonality and a trend to confirm it. I got like, okay, this is going to be a good trade.
Right.
So I like to put them together, and that's great. Now I will take if the trend is up and the seasonal is down, I'll still take that uptrend, because that's how much faith I have in trend. Mm-hmm. I do not. I used to let seasonals, persuade me, say, no, it's not a seasonal buy, and there's a trend that's going down. Don't short it, like that. Mm-hmm. But I found that anything can impact the seasonal. There's so many variables in there, but when you can get them to coexist, that is trend and the seasonal, then to me that's a pretty strong setup.
With your comments about bonds, obviously I'm looking at the bond futures here, so I got the ZB, the ZN, and you can clearly see that. But what was the time frame that you said it typically has a bullish cycle?
It's around July till the end of August. And if you look at that on a percentage, I get RCI put that thing out, and it's almost 100% for the last 15 years. And 15 after that, 15 before that. Yeah. It's just that's how it is. The interesting thing is it doesn't have to be just a 10 or a 30. It's everything from euro dollars, which is 90-day paper, all the way up to the 30 years. So you got the 90-day, 2-year, 5-year, 10-year, and the 30-year. And they just get a really strong bid in at this time of the year. Now, can we rally one up until September and then start a new trend down, with higher interest rates coming in? Of course, anything can happen. But with this season, when we were so oversold in prices on these markets, mm-hmm. It was unbelievable. So it was almost like the perfect storm for the interest rate prices to turn down.
Yeah, and I think a lot of people are loving it, because as these bond prices increase, that means that yields are falling. So you might see the housing market stabilize a little bit. And again, there's all these dominoes that fall into play. It's funny how some people will focus on one market exclusively. Like I remember when I first started off, I was only equities. I would only look at equities and on short-term time frames and like, oh, wait a minute, equities are manipulated or moved by the futures. And oh, well, futures are moved by currencies and currencies are moved by bond markets. It's like, holy cow, this is giant, everybody's pushing different directions. And little things like this are interesting because it can give you a leg up, especially as if you're a trend trader and anticipating when those trends may turn, if not. So I put a little vertical line here, end of August, just to see if how this one pans out. But nice bullish cycle here for a couple of months on the bond products. Yields have been falling, so maybe we'll see home numbers start to tick up a little bit. Now, here's the most important question of the day, because apparently, according to Jerome Powell, chairman of the Federal Reserve, we are not in a recession. According to our president, we just need to change the definition of what a recession is. So I'm curious, from your perspective, are we in a recession or not?
If we're not in it, we got one foot in it. Let's put it that way. If we don't have both feet in there right now, but we definitely have one foot in it, and there's just no doubt in my mind we're going to see one coming there.
Yeah.
I mean, the inverted yield curves we have right now across so many different maturities is unbelievable. And then there's that one that I was talking about before the show with the T-bill and the 10-year.
Mm-hmm.
That thing is like literally just inches away from flipping into another recession.
So if we are in fact, and I believe we are in one, I definitely think we got one foot. I think we're actually up to our knees in it right now, but who knows? I could be totally wrong. It happens. If we are in a recession, what are the typical impacts on the commodity markets when we are in a recession? Like, how does this impact demand globally, and what are some of the things to look for if, in fact, we get that declaration from the, National Bureau of Economic something that says, hey, we're officially in a recession, all the headlines say it. How's that impact commodities?
Okay. Well, if we wait for that report, usually that's when the stock market will bottom and turn.
Yeah, buy the rumor, sell the news.
Pretty much, exactly. So, but if you think about like with a recession, especially like in livestock with for cattle, eating like steaks and good cuts of meat and stuff like that is considered a luxury. And so when you go into a recession, that type of stuff, from your expendable income, that type of thing starts getting cut from your list pretty darn quick, right? You start saying, that hamburger looking pretty good compared to that fried bread tonight. So you start making a few sacrifices in there. The other thing, you got to start thinking about energy, right? I mean, people are just not going to be spending as much money traveling on vacations and stuff in a recession. And they might be a little bit more concerned about keeping their jobs and, maybe don't have enough money saved up, whatever it might be. But you're not going to see the big drive for vacations, right? Which cuts down on oil consumption. Well, remember, sugar and corn are huge contributors to ethanol for that. So they're going to start seeing a drain on that as well. Also, the same thing with your corn. As far as corn prices go, if there's not a lot of beef out there, a lot of demand for beef, you don't need to feed as much livestock. So it's this whole chain reaction that comes out of this. That recession really puts a lot of pressure on commodities because it just starts to beat back down to a more affordable price. I heard somebody talking the other day about the DBC, the index for commodities, and they could not get it through their head. They're going like, I don't get this. We go to the store and everything's going up and up and up, but yet DBC prices are coming down. Well, it's pretty simple because DBC is based on wholesale prices, right? And if these big companies have already hedged into the market and these prices continue to go up a little bit, they stay hedged like that. This is why when lumber went up to $2,000 recently, last year or whatever it was, companies like Lowe's and Home Depot, they had to buy a ton of lumber up there at these super high prices because they had to hedge, right? They didn't know how much tire was going to keep going. So they had these hedges on, and even though lumber had come down way under what any of those hedges were, they couldn't sell it cheaper than what they were hedged for because that would have been a huge loss for them. So they had to get rid of their inventory to get the hedged amount, and then they can start lowering the prices again. So it's something to keep in mind that when you see huge price increases like this, a lot of these producers or companies, I should say, who have bought that product, they're sitting on inventory. They can't just give it away. Right? They're locked in with hedges, and therefore those prices stay elevated a little bit longer, and then eventually as the inventory gets depleted, as hedges come off, prices start coming down. So that's something to keep an eye on as well. But recession will hit commodities really hard. I mean, there's just no other way around that because just people don't spend money as much as they did when things were really good.
Well, I think the charts kind of are, supporting that argument that we are in a recession. I mean, this isn't even off the all-time high of lumber, but here's just a lumber chart just so you guys have some numbers. I know we have some people listening to podcasts. Lumber itself, just lumber since the high achieved in beginning of March, so 106 days, 64% slide in lumber. And in theory, what this should do is down the road, this should be a catalyst for housing, right? All of a sudden, the production cost of a house is, well, at least from the lumber side, has dropped by 64%. I mean, Toll Brothers, Lennar, KB Homes, they're just loving this. You look at other commodities out there. Let me scroll down here and go to something like wheat, right? I think Wheaties is one of the most disgusting cereals ever made. You just pour milk on a soggy pile of wheat. It's just gross, but down 39% in 55 sessions. I'm sure that the Kellogg's is going to start to have better earnings down the road, but not immediately, right? There's a latency for this stuff to get through and ultimately hit our pockets.
Exactly. Yep.
Go ahead.
Oh, no, go ahead.
I was going to say, next week, you mentioned that there's some pretty big announcements happening next week, and I thought maybe we can kind of wrap up with that one. Obviously, as a trader, I'm looking at things like GDP numbers and CPI and earnings announcements and all that type of stuff. As a commodity trader, you look at a few different announcements. So tell us about what is coming out next week and what the impacts might be for the market.
Okay, well, the one I was mentioning the most about was the USDA's crop report that will be coming out next Friday. And this one, it's the August USDA report is going to be coming out. And normally it doesn't move the market a lot. But this year, there was like a late planting that went on, whether it was the heat or the rain, whatever was in the beginning of the year. But the farmers had a lot of trouble getting the crop in the ground early. So they didn't have a really good idea of how many acres were actually planted. So this report actually for August coming up, that's one of the things that's really going to be keyed off of is, how many acres truly were planted. So this is going to be one of the first times they're going to get a look at that since the planting season. Normally, that's not a big deal for this August report coming out, but it is going to be for this one. So now the USDA has had like satellite imagery of all these acres that have been planted. So they got a lot better view of their yield and everything, our estimates is coming out for it. So this is going to create some pretty serious volatility next week when we see this report come out on Friday. But it's all based off that late planting part of the season.
Let me ask you, how much, I guess, weight and trust do you put into these announcements? So, you talked about Department of Agriculture. I look at an announcement that comes out every single week, and it's one of those ones that just, I laugh out loud every time I see it, and that is the crude oil inventories number, right? So, because, they're like, oh, well, we're going to expect a contraction of 7.9 million barrels of oil, and all of a sudden it's like, oh, we had a surplus of 10.5. Like, you were 17 million barrels. I could fit football stadiums from the floor to the ceiling and still have leftover oil. How can you be that colossally wrong? I'm hoping that the I guess accuracy is a little bit better for some of these commodity reports that you're looking at, because I refuse to look at the crude oil inventories number. I think it's a joke.
Well, it not only is it a joke, but I don't know if you heard the story about those, but that the oil for delivery for that is from Cushing, Oklahoma. And out there, they've got huge tanks. Literally populating all that land out there. And that's where they store the oil at. Well, there's a company, if you ever notice, like on a gas propane tank, like on your grill, for example, you don't know how much gas is in that.
Yeah.
Unless you got a great piece of meat on the grill, then you can bet money that thing will run out of gas.
True.
But the point is, if you have a propane tank, this is what we did in the old days. No, my grandparents did this. I didn't. But you take a boiling hot water, pour it over a propane tank, you'll see a frost line form on there, and that's how much propane gas you got.
Mm-hmm. Yep.
So anyway, what they'll do now, there's a company that has satellite imagery of the Cushing, Oklahoma tanks, right? So they can take with thermal imagery and get better ideas each week how much those things are going up or down.
Wow.
And that is sold to, obviously, anyone who can afford it, thousands of dollars for this report prior to that EIA number coming out on Wednesdays. For anyone who trades that report and you're betting against people who pay thousands of dollars for this report, you've missed the boat by the time that report comes out. So it's like, and that's why sometimes you'll see the number, like the inventories were way up, right? But people already had an idea what that number was truly going to be. It was much higher than it was supposed to be or much lower than supposed to be. And they've already bet on that days before the report comes out. And it's like, you can't trade that kind of news. It's totally absurd.
Yeah.
Trade off of that kind of news.
Good. It's become a joke, honestly. Like every time I see it, I laugh out loud. Like the one that came out yesterday, they were expecting a contraction of 1.4 million barrels. We got a surplus of 4.5, and it's like, I just can't. If I was that wrong in things that I did for my job, right? You know, like if I'm an electrician and I'm like, oh yeah, this is 220 watt, you know, and it's actually 7,000 watt. They're so unbelievably off. It blows my mind. So you do put faith and trust in some of these USDA reports and some of the other reports that come out?
I still never trade the information, but I do look to see, is it close to what these people were looking for, especially when it's USDA. And I try not to get into the micro side of this stuff, but I do like to look at the bigger picture and just see, what are they keying off of for this report? Because it's never the same thing. There's always something that's kind of like, okay, this is what we're looking for. Because you might think it's just a headline number, but there's something buried under that number is what they're really looking at. So that's I'm just kind of digging a little bit deeper to see what is that number they're looking for. What are they paying attention to more? Like for this time, they're more concerned about that, late planting more than the actual number that's going to come out. But that late planting is what's that going to do to the yield? So anyway, that's going to be kind of interesting. And obviously there's going to be some demand questions going to get answered out of this as well. And obviously Ukraine with the situation out there, that's how much more crop can come out of that country.
Right.
And then also we've got the other thing with the issue with Pelosi just going over to Taiwan. Is that really going to upset China to the point where, we don't need your corn no more, we'll buy it from Brazil, that kind of thing. Brazil's again got that second largest crop coming out this year. So their second crop is coming out. It's supposed to be huge. So that's going to be something that will be very competitive. One thing to watch for that will be the Brazilian real, the currency. If you start to see that go into a downtrend as Brazil harvests its crop, that's going to put even more pressure on our corn prices to go down, because Brazil will be able to ship a bunch of stuff out if their currency gets weaker. So that's going to lower world prices of corn, which means ours has to go down and be competitive with it. So watching the Brazilian real at the Brazilian harvest season for the second time, that'll be an important term there. So again, weekly trends or even daily trends on that real coming into harvest season is a significant number when you know that Brazil is having a really big crop.
Okay.
Anyway, I'm sorry, go ahead.
I was going to say, I got two more here, and I want to let you loose because I don't want to take up all your time. Rudy says, what about DBC? Will it continue to drop or turn to the upside? I mean, you get to put your Oracle hat on right now and talk about commodities. DBC, for those who don't know, is the Invesco Deutsche Bank Commodity Index. I'll let you get your take on that one. What do you think?
It's heavily grain weighted too. Okay, so that one, it's not like the Goldman Sachs Commodity Index, which is energy weighted. So DBC is very, very, or at DBA, Deutsche Bank's agricultural, they're both very heavily agricultural weighted. So this type of report coming up, that's the other thing too, that with people making comments about how this report comes out next Friday is pretty much going to set the trend for the current or the grains going into the harvest season. So you can see for the next 2 or 3 months, if this comes out as a bearish report, that's going to keep DBC down along with it. If this report comes out super bullish, it's going to help push DBC back up. And that's where the grain market is going to go to. So there's a lot riding on this report next Friday. So again, the way I'll look at it is, how does it impact the trend? When we start out the following week on Monday, is it going to keep the trend in the direction that it is, or is it going to start turning to go the other way? So that would be the final answer for me. I'm certainly not going to buy or sell because of the number that comes out.
Right. Wait and see how it impacts things. All right, last one, and I'll let you run. This is from Skilled Stocksman. He says, copper on the weekly chart came from 302 to 322 demand area. Do you see copper? Let me pull up the chart here for people can look at it. Do you see copper rallying from here? And what are the impacts do you think it might have for the equity markets up or down?
Yes. The copper market, you're seeing a lot right here. It's just a lot with China. China's a huge, they store, they call them, the pigment is what they come from, but they call pig farms. And they store physical copper over there for all of their infrastructure and stuff like that. But when their economy slows down in China, that's what you start to see is this sell-off we had in the copper market here. So if you'll keep your eye on China as far as when they start opening up more and they start to expand their economy, you're going to see copper turn around. But in the meantime, copper's got some more downside to it because it doesn't look like anything great is happening in China right now.
Yeah, it seems like that whole thing is heating up and starting to get a little bit uglier, contentious.
That'll be the first place you'll see copper make this. Once China starts talking, then, the other places around the world, maybe it might be Europe or it could be the U.S. coming back online, getting their GDP back to positive again, then you're going to start seeing more infrastructure work. But until China gets their act together over there, not looking good for copper right now.
Yeah. Well, hey Don, I don't want to take any more of your time. It's been like 4 years since I've had you on a show, so I'm hoping the next time it will be more frequent than that. But as always, you just hit me with a fire hose of information on an asset class that I find fascinating. So on behalf of myself and all of my viewers out there, thank you so much. I'm sure they learned. I'll see if I can figure out what was going on with the audio, but hopefully it came out okay on their end. But thank you so much for coming on, and hope you feel better. Have a fantastic remainder of your weekend, my friend. I will see you soon.
Okay, thanks again. It was good seeing, well, I should say, listening to everybody's questions and everything. So hopefully see you around soon, and good luck with your trading and everything.
All right, take care. Bye.
Okay, take care. Bye.
Guys, that was Don Dawson giving us insights into the commodity markets, filling in a lot of areas that, honestly, it's just kind of head-scratching when you look at some of these moves out there. Apologize for the audio. I'm going to actually spend some time this weekend, see if I can fix it, because I noticed a couple of the podcasts, the guest audio is really kind of weird, and maybe it might be the way I have this thing wired, so I will try to fix that. But guys, Don teaches pretty much only at the Kansas City office out there for Online Trading Academy, but man, what a wealth of knowledge. You can just tell how smooth and quick, I mean, this guy knows his materials, and it's actually been somewhat inspirational for me in my area of expertise. You know, I obviously love commodities. I'm interested in them. I don't have the knowledge that he does. I really love, cryptocurrencies and equities and futures. So I kind of pride myself on digging as deep as I can and finding out what really makes these things tick. And I think that Don really made that very clear with the commodities session today. So you can find out more information about Don. I guess the only class he'll teach is in Kansas City at this point. Okay, let me wrap this up because I have to run today, so I don't want to spend too much more time. I noticed I had a couple other questions, but I got to Skilled Stocksman. Linda, I'll get to your question on cryptos tomorrow, and then I got a couple others that were posted I will get to tomorrow. Here is what is coming for tomorrow, so I can wrap this show up here. Economic calendar for August 5th. You can see some huge names on here. Brandon Tristan works for He Who Shall Not Be Named, the Voldemort of the trading world, gentleman who thinks he's the best in the world, but he's absolutely a scumbag out of Chicago. So I, unfortunately, will not have anybody that has anything to do with that Chicago quasi-trader on this program anymore, unfortunately. So Brandon's a good guy, but you know what? You work for the enemy. You can say goodbye to being on my program or communicating with me. Let's see. Unemployment numbers. That's what I wanted to get to. Right in the middle there, 5:30 a.m. Eastern Standard Time. So Pacific Standard Time. 1 hour before the equity markets open up, you can see the biggies. You have 3.6% expectations for unemployment rate, right? Any deviation from that is going to create waves. My gut, I believe we're going to get 3.7. I just feel like it's going to slowly tick up, just a hair tick up here. And you're starting to see more layoffs. Walmart's doing layoffs. I saw a comment there in the room earlier about Walmart doing some layoffs. It's growing. We're seeing more and more layoffs just to cut costs. Going into recession, companies are going to do what? They're going to cut costs so they can stay afloat longer. And that means getting rid of employees, maybe less corporate spending, less marketing, less ads, and things like that. So I think it's going to be slightly higher than 3.6 tomorrow, just my gut feeling. Now, what's weird is you look at the unemployment is expected to stay the same, but look here at non-farm employment change. The expectation is there's going to be a significant decline in the number of jobs available, which could lead to one of two things. Either there are fewer jobs available for employers. They're not offering as many jobs, or just people have taken so many jobs that we're going to see a pop. So either way, you could argue this non-farm employment change tomorrow, but that comes out at expected to be 250,000. You can also see average hourly earnings coming out tomorrow, and then that pretty much wraps it up for the U.S. Now, you also have unemployment, and there's a tick up expected for Canada, going from 4.9 to 5.0. Now, we still have some earnings to talk about. You've got Canopy Growth. Berkshire Hathaway will be reporting earnings tomorrow, and everyone wants to hear what Warren Buffett has to say. Western Digital, you have Global Partners and Goodyear reporting. All those are going to be before market open because tomorrow is a Friday. Yes, it's a Friday, my friends. So tomorrow I will most likely have a nice glass of whiskey, some nice shout-outs. We've had a pretty rough... we had some sad news this week with regards to a bunch of real celebrity deaths. Uhuru died from Star Trek. What an icon that was. And Vin Scully, even though I despise the Dodgers, I'm a Giants fan, grew up in NorCal. Hard not to like Vin Scully, one of the greatest announcers ever to don the microphone. So tomorrow I don't have a guest. It'll just be me and you, the group here. So have questions prepared for me or send them on in. You can go to whatever YouTube video you want of mine and just type in your questions down below that. I'm putting putting them in the slides, and I'll make sure I get to all those tomorrow. Or you can email me. It's on the screen. Of course, I didn't even update my date today. How about I just update that to make me not look so stupid? There it is. The 4th today, not the 3rd. If you have questions for me personally, you can email me, TraderMerlin@gmail.com. That said, thank you very much. I'm glad you guys enjoyed Don Dawson. What an enlightening show with regards to commodities. We'll get many more guests, hopefully. Oh, yeah, Bill Russell as well. That was a tough one. Yeah, Bill Russell. I don't know how I can forget that one. A sad week. They say it happens in 3, so no more big, important celebrities dying this week. Please, let's not have it. But I'll have a nice show tomorrow. I'll have some whiskey in hand. Hopefully you guys will join me as well. So take care, everybody. I will see you all tomorrow.